Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Frank Pereira. The Reserve Bank of India, in its monetary policy on Wednesday, kept repo rates unchanged at 6% and the reverse repo rate unchanged at 5.75%. The RBI has lowered economic growth projection to 6.6% for 2017-18 from 6.7%. It has estimated 7.2% growth in the next fiscal. The central bank said GST was stabilizing and that economic activity was picking up, adding that there are early signs of investment revival. It also said that the exact magnitude of MSP rise on inflation cannot be fully assessed at this stage. The Monetary Policy Committee also said that a pick in credit growth was likely due to bank recapitalization and resolution proceedings under IBC. The RBI attributed volatility in financial markets to uncertainty over the pace of normalization of the US Fed monetary policy. On this edition of The Big Picture, we will analyze the RBI's monetary policy review. Joining me on the program today are Nitin Desai, former Chief Economic Advisor to the Government of India; Ajay, former Secretary, Ministry of Commerce and Industry; R.M. Mallah, former CMD, IDBI Bank; and A.K. Bhattacharya, Editorial Director of the Business Standard. Thank you to all my guests for joining me on this edition of The Big Picture. Mr. Bhattacharya, I'd like to start with you, of course. Why has the RBI kept the rates unchanged?
Well, in my view, the opportunity to reduce the interest rates, the repo rate, has gone. In a sense, when inflation rate was a little benign, almost the whole of the last year, you saw only one rate cut.
That was in August.
Yeah. And when the inflation is climbing and everybody is aware that inflation is climbing. You have government fisc, as RBI governor rightly pointed out, there are three stages of the fiscal slippages. At one level in the current year, the second year, and then even the long-term target has also been postponed. Then you have got the crude oil price increase possibility. Then you have the possible impact of the MSP increases for the agriculture sector. And most importantly, the normalization of the central bank policies globally will also have an impact on the liquidity situation and the bond market. So therefore, keeping all those factors in mind, RBI has taken a view that why do anything on interest rates, keep it on hold and see how it goes going forward. The interesting point is that it has maintained a neutral stance, which means it can move in at any point in time. The expectation was that it might raise rates, but the fact that it has not raised rates has actually soothed the bond market. So I'm not surprised, and it's a 5-1 verdict in favor of maintaining the current repo rate.
Sure.
So I think the opportunity of reducing interest rates have gone, and if anything, going forward, depending on how inflation moves, you will see how the RBI looks at the interest rate, not bringing it down, but probably raising it.
Okay. Mr. Desai, what does the neutral stance really mean? How is the RBI going to, act going forward?
I think a lot will depend on how the inflation situation pans out. I want to add one more factor to what Mr. Bhattacharya has just mentioned, and that is the narrowing of the gap between the US interest rates, or rather interest rates in development, and the Indian interest rate. A great deal of the inflow which was coming into India was frankly carry trade. It was tough coming into the bond market here. It was not going into equity market. A lot of it was into the fixed interest segment. And that gap is now narrower by about at least 1 percentage points. So there may have been a certain nervousness here that with interest rates rising there, if we were to lower ours, then there would be a serious impact on the foreign portfolio inflows into the fixed interest market. And I suspect, though this is not mentioned, let me be frank, it's not mentioned in the MPC report, but when they say that a lot depends on what happens to the normalization there, this is the other thing. The second thing which I would add is there is a reference there to liquidity situation becoming a little less easy than it was at the time of the last policy review. They have a reference in their statement. Though it's still there, I mean, still the call rate is still below the repo rate. So, but it's nevertheless, they're saying it is narrowing, and they expect, it appears, because of the growth in credit, they expect that situation also to come down. Third, their references to how growth is going up is partly a response to the people who say you need to reduce interest rates to boost growth. So no, you don't need to do it. After all, the growth is, but it is happening, so we don't need to reduce interest rate. Neutral, basically it means that they will go, whether they go up or down, will depend on how the inflation situation pans out over the next few months. But essentially they're saying we could go either way. They're not, but I do think there is a certain nervousness in their statement about inflation. They've said that. That H1 they expect inflation to be above 5%.
5.1, yeah.
5.1 to 5.6.
5.1 to 5.2 or something like that. And they expect it to come down only in H2.
Sure. All right. Ms. Mallah, I'd like to bring you into the debate now. You know, of course, while inflation targeting remains a major concern, but also stimulating growth is equally important. How do we strike a balance between the two?
The excellent question. You mentioned RBI's monetary policy. I would like to differentiate. It is no more now RBI's monetary policy. There is a monetary policy committee which comprises 3 members from Reserve Bank of India and 3 eminent economics like Mr. Desai mentioned. And you know, we have become so transparent. Earlier what they used to say was told later, but now it is told upfront. And as you were mentioning that 5 were in favor of maintaining the rate and 1 said that rate should be increased. Vis-a-vis last time, 5 said the rate should remain same and 1 said rate should be reduced. Now, you know, 4 plus minus 2 is the target. We have a target given by Government of India, and Reserve Bank has to ensure that we remain within this band. The best will be to close to 4. We have already crossed 5. And the 2 factors which were mentioned, one of course is MSP, second is also arrears of certain payments by state government and all that. I believe that, you know, and they have still said, you know, neutral policy. People were even expecting that it could be cautious. Going forward, that rate will increase. And if you see the banking system, some of the banks have already started increasing the rates of interest on bulk deposit. So, as Mr. Bhattacharya very rightly said, this is the time when we have to be careful because inflation targeting is most essential for this nation to have a sustainable economic growth in this country. And what they have done is exactly on the expected lines.
Sure. Mr. Duat, this brings me to my next question. Should the RBI continue being an inflation targeting body?
That's a very big question. The monetarists and the RBI, as you know, looks at monetary issues as its primary concern. A debate which has been going on for decades and not just in India, the world over. That should they be concerned, the central banks, should they be also concerned with growth, equity, other kinds of issues which are to be addressed, or should they be only looking at monetary issues? The bank's stance has been that, look, we are doing a particular sectoral work and the instruments which we have or tools which we have in our hand are mainly monetary in issue. So we talk about those issues, whether the liquidity, rates, etc. Just moving on, but if you see in today's statement of the report, the recommendation of the MPC and what was read out by the governor and his 3 DGs, who also deputy governors who also answered questions, to allay the fears that any recommendation by the MPC could have disturbed the markets much more than what I think the system was prepared for, the ecosystem wasn't prepared for. So they have devoted a fair amount of time to saying, all right, we do see inflation rising. It has risen already, and for factors, 6 factors they listed out, and for on all those reasons, for also it could go up. But at the same time, the governor took pains to point out that, look, things are reviving in the economy. We already see credit growth, as he said, after a long time is in double digit, 10%. And with all the action now, proposed bank recapitalization, IPC, etc., it will further improve. He also talked about in a question which was put by one of the persons present, that will the investment GDP ratio be rising? He says yes, we can see that things are auguring well, etc. So he has gone into saying, all right, things are looking better. Inflation may be an issue, but I think that will get managed.
Okay. Okay. You know, Mr. Bhattacharya, so going by what the RBI governor has said, you know, he has also said that investment is picking up. That has been a major concern for us over the last year, year and a half. So considering that investment is picking up, is that why the RBI has said that it is going to keep interest rates unchanged?
This is one of the reasons you can conclude. I think, you know, as Dr. Desai rightly pointed out, because he is presenting a picture that growth is picking up, he doesn't see any reason for being hawkish on the interest rates front. So much against the expectation that he might raise interest rate, he is saying that growth is picked up, so why not you remain neutral on this issue. And what is he relying this expected growth on investments on? He is relying on the latest numbers on the capital goods sector production, relying on the credit growth, and he's also relying on the capacity utilization level, which has got slightly better, not very much, but slightly better.
And optimism on
exports front.
The global economy
so if he's relying on all these factors, so probably he is looking at exports growth to pick up next year, and if that happens, he doesn't see any room for taking any action going forward. So which
the growth
is why
estimates are at 7.2% for next fiscal
year.
Yeah.
So which is why he's maintaining a neutral stance, and which I think is probably, given this current situation, is a sensible position stand to take, because you do not know which way the inflation will move. So therefore, you have to be cautious. In my view, he has taken another very important step in this policy, which has not come out in the actual policy announcements, but it is his approach to the MSME sector. Now, the MSME sector, he has actually relaxed the income recognition norms for NPA calculation, and if you are GST registered. Now, in my view, it's a clear attempt at allowing MSME sector to come into its own.
The MSME sector got a major boost from the budget, as well.
Also.
So is that the sector that we need to watch out to?
Absolutely, absolutely. So therefore, the MSME sector treatment is a very significant monetary policy response to MSME sector woes, and they also do account for a good share of exports. They also have a share in the jobs. And the government has also tried to, tackle the problem of MSME sector through his measures. So that's an additional policy thrust I see in this review.
Okay. You know, I'm going to go back to a point that Mr. Mallah was making, Dr. Desai. You know, he said that the MPC has come into existence only in 2016. So how has it changed the way the RBI looks at monetary policy?
Well, basically, it has become almost completely inflation oriented. RBI policy has always been a little more flexible, taking both things into account. And if you talk to the old timers from the RBI, they are not entirely convinced that this is the best approach. Incidentally, I noticed that in this time statement, when it says that our goal is 4% plus minus 2, they have added a little phrase saying keeping the imperatives of growth in mind or something like that. So now they're recognizing that it can't be just that. I really am of the view that this single number targeted fiscal and monetary framework that we have developed is not a very sound one. That for two reasons. One, that you must respond to what are the current economic conditions. And you can't just say 3% and that's it, regardless of what is happening in the economy.
And what do the current economic conditions call for?
Well, I would say, let me say that I am not as confident about the rising investment as the statement seems to be. If you look at the CMI number on new projects in the quarter ending December. It is the lowest in 13 years. New projects on corporations in the quarter ending December is the lowest in 13 years. Now that's a worrying trend. So I don't, yes, there is probably some slight improvement in capacity utilization, but it's very slight. Not yet at a level at which people are going to face capacity constraints in meeting demand and leading to more investment. Second, the balance sheet problem is still in the process of resolution. A fairly large number of corporations are still in that process. It's not as if it's not going to get resolved that quickly.
But the TBS problem is being looked into.
It is being looked at, but it's not resolved. Till it's resolved, they can't get into the market. You can't expect the people who are under IBC procedure or are likely to be under IBC procedure to start investing. But so if it comes, I would say that the one hope I can see is if they can get the MSME sector moving again. That sector has taken a huge hit last year. If between the budget and the provisions which...
Clearly the thrust is in that direction.
If it comes. But it's not going to be that easy because I don't think it's going to come that quickly. So I would be a little more cautious in expecting investment increases to be there. And in any case, I personally believe that the policy must be, first it must, secondly the external balance side.
Okay. So yes, Mr. Dua.
Two things. One, the investment is also driven by private investment, but the confidence which they have about the future, the PMI index. I think that started doing well. It is above the 52 mark. You know, with 50 being the neutral one. So I would think that people do think that things are looking up, and that's positive aspect for investment decision. Second is this small industry, medium industry receiving concerted attention from the government, and also now to address their basically the GST woes. That they said, what's the today's what the RBI has announced? They should have been standard accounts in August last. After that, and if the turnover is below a particular limit, 25 crores, then they are, for 6 months' time, they are not going to be treating them as defaulting companies and give them extra time. And the idea being that these companies were doing reasonably well because of a government measure, they've been hit. So let's try and help them out. Again, a very positive thing. And thirdly, I think the situation is to a large extent also dependent upon how the budget gets implemented, particularly in the agriculture and rural sectors, because the aggregate demand is to come from there. We have all seen the FMCG companies looking up their performance as well as their position in the market. The last quarter 3, for the results which have come, I think all of them, the FMCG companies, have done better than in the past.
Sure.
So that to me gives a bit of more optimism than what Dr. Desai mentioned, that there could be some sort of a revival. It may be consumption driven.
Okay.
The expenditure of the government may be more consumption oriented than the investment driven, which would have been had it come from the capital side.
Sure.
But there could be much more economic activity going forward. Whether we have elections or not, this is a time, if the monsoon holds out, that we could see better economic activity than in the recent years.
Okay. Mr. Mallah, taking off from where Mr. Dua just left, he said that he spoke about the agriculture and the rural economy. The RBI or the the MPC has given a thumbs up to the agriculture and rural budget, but has it also factored in the MSP?
Yeah, actually, MSP, was arbitrarily every time fixed by various states, central government and things like that. So at least now we have a formula that if 100 rupees is the cost of production, he must get 150 rupees. But this has to be worked out on what basis. Is his wages also included or only other outputs? So what I believe is his notional wages, suppose 4 persons in a family are also working, their wages should also be included because he could always employ someone else also. So that is one factor which must work out, because we are going towards a situation where farmers' income must be double by 2022. And we believe it should happen because there is huge distress in agriculture today and it has to be removed. Now coming to MSME, very interesting facts my colleagues have just now mentioned, but one very important thing is there are a large number of exporters who are in MSME. Now earlier they never had to pay GST. Now they have to pay GST and claim this back from the government. So I really appreciate Reserve Bank of India saying that those who are GST registered, and if there is a default after 1st September till 31st January on because of whatever factor, they will get 180 days window and will not be treated as NPA. This is a huge benefit to banks. Banks will be encouraged to lend them more because what happens if something becomes NPA, banks tend to stop their further working capital.
Yes.
Along with that, very interesting thing has happened. Earlier, if the loans were more than 5 crore or 10 crore, they were not treated as priority sector. Now Reserve Bank has done away. So that is one area where now banks will be more motivated to give money to MSME. So very positive thing.
Right. You know, I've got time for one final closing comment on the program. Mr. Bhattacharya, does, you know, what's likely to happen? You know, the last rate cut that we saw was in August 2017. Will we see another rate cut in the near future or that is done away with?
Well, you know, I think we have to wait till April when the next policy review is due. Given the current situation, I think you have to acknowledge that what RBI did today is actually also managing the bond market. The bond market, the 10-year government paper has seen its yields rising quite menacingly. And I think it is not a good situation that it created for the government of India, which has got a huge borrowing program going forward. So today's policy, which is far less hawkish than one expected, actually may have cooled the bond market somewhat, hoping that a rate hike may not be coming any day soon.
Sure.
So to that extent, I would say that it is cooled the market. But in April, my sense is new factors, new developments will be available, new data would be available, inflation will be available, crude oil price, the US market will be more clear. So we have to see what really happens then, but we have to wait till that time.
Okay, let's wait till April then to see what exactly is going to happen. All right, on that note then we'll call it a wrap on this edition of The Big Picture. I'd like to thank all my guests for joining me on the program and putting things into perspective for us. That's it from me. See you again next time.